welcome to the Property Wealth Podcast. I'm really glad you're joining us today.
Absolutely. It's great to have you here. We're diving into something super interesting today, how to get approved for 5 or more properties.
Right. I mean, that can sound a bit daunting, huh? But it's really about understanding the process and making sure you position yourself well.
Exactly. A lot of folks think it's impossible, but with the right approach, it's definitely achievable.
We'll be talking about key strategies to improve your chances of getting those approvals, like understanding your credit score, knowing what lenders look for, and even how to build a solid portfolio.
And we'll touch on some common pitfalls to avoid, too. Things that can trip you up if you're not careful.
Plus, we'll share some real-life examples, so you can see how these strategies actually work in practice.
Yeah, real stories always help put things into perspective. It's all about creating a roadmap to long-term wealth through real estate.
So whether you're a seasoned investor or just starting out, there's something here for everyone. Let's get into it.
Sounds good, Sarah. Let's jump right in. So, Sarah, it's really crucial for people over 40 to think about property investment right now, especially with the way the market is shifting.
Absolutely, Mike. I mean, a lot of folks in that age group are starting to think more seriously about retirement, right?
Exactly. And with rising inflation, the idea of securing a stable income through real estate is becoming more important. You want to make sure your assets are working for you, not against you.
Right. I think many people are realizing that traditional savings just aren't cutting it anymore. A fixed income can be pretty scary when you consider how prices keep climbing.
For sure. I had a client, let's call him Tom. He was in his late 40s, and he was really concerned about his retirement plans. He had a decent 401k, but with inflation eating away at it, he felt like he was on shaky ground.
That must have been stressful for him.
Yeah, definitely. So we talked about how investing in rental properties could give him a steady cash flow, which would help him feel more secure. He ended up buying a couple of multifamily homes, and now he has that additional income stream.
That's a great example. It's like building a safety net, right?
Exactly. And it's not just about the income. It's also about creating a legacy. Many people in their 40s and 50s are thinking about how they can provide for their kids, or even help with future grandkids' education.
Yeah, I've heard stories where parents are buying properties not just for themselves, but to pass down to their children. It's a way of transferring wealth and making sure they have something solid to fall back on.
Absolutely. I had a woman, let's call her Linda. She was in her early 50s and wanted to ensure her daughter could afford a home in the future. She decided to invest in a property that would appreciate over time and eventually be a gift to her daughter.
That's so thoughtful. And it's smart too, because property values tend to rise over the long term.
Right. And with today's market, we're seeing some shifts that can be advantageous for savvy investors. Even with interest rates fluctuating, real estate can still provide a hedge against inflation.
So you're saying property values often keep pace with, or even outpace, inflation?
Exactly. When you own property, as costs go up, so typically do rents and property values. So it's a way to protect your investment.
That makes total sense. And for those who might be hesitant, it can feel daunting to step into the market, especially if they've never done it before.
Totally. But even if you're starting later in life, it's never too late to begin. I've seen people in their 60s dive into real estate and do really well.
Wow, that's encouraging. What do you think holds people back from getting started?
A lot of it is fear of the unknown, right? Or they think they don't have enough time to see returns before retirement. But the reality is, real estate often benefits from long-term hold strategies.
Definitely. And it's also about mindset. If you can shift your thinking from I'm too late to I can make this work, it opens up so many possibilities.
Exactly. And think about how many people are in the same boat. They're worried about market volatility, but real estate can be a stable investment.
That's true. So many investors focus only on stocks or bonds, but property offers that tangible asset. It feels more secure, doesn't it?
For many, it does. They can see it, touch it, and manage it. That physical aspect can be really comforting.
And when you think about the emotional side of financial security, it's powerful. Knowing you have a reliable income source can reduce stress and provide peace of mind.
Absolutely. I remember a couple I worked with, let's call them Steve and Clara. They were both in their late 50s, and they felt overwhelmed by the thought of retirement. Once they started investing in rental properties, you could see the weight lift off their shoulders.
That's such a great story. It's amazing how property can change not just finances, but the overall outlook on life.
Right? And it's about creating options. When you have multiple properties, you're not just relying on one source of income. If something happens, you have that cushion.
And that's especially relevant today with all the economic uncertainties we're facing.
Exactly. People are looking for ways to diversify, and real estate can be an excellent avenue for that.
It sounds like now is just the right time for people over 40 to take a serious look at property investing.
For sure. And the beauty of it is, there's so many strategies to consider. We're just starting to scratch the surface here.
Yeah, it's exciting to think about all the possibilities ahead. So, what are some core strategies that can really help people take that next step?
So let's dive into some core strategies and rules of thumb that can really help you get approved for multiple properties.
Yeah, I think starting with the basics makes sense. What's the first thing people should keep in mind?
One of the most fundamental rules in real estate investing is the 1% rule. It's pretty simple. If you're looking at a property, it should ideally rent for at least 1% of the purchase price each month. So if you buy a house for, say, $300,000, you'd want it to rent for about $3,000 a month.
That's a handy benchmark. But what if the market doesn't support that rental price?
Good question. In that case, you might have to look at other metrics. For instance, the 50% rule is another useful guideline. It suggests that roughly 50% of your rental income will go towards expenses, things like property management, maintenance, insurance, and taxes.
Right. So if you're bringing in $3,000 a month, you should expect around $1,500 in expenses. But how do you know if it's still a good deal even after that?
That's where the capitalization rate, or cap rate, comes into play. It's a measure of the return on an investment property. You can calculate it by taking the net operating income and dividing it by the property value. So if that same property has an NOI of $30,000 a year, the cap rate would be 10% if it's worth $300,000.
10% sounds pretty good. What's considered a decent cap rate?
Typically, anything above 8% is considered strong, but it really depends on the market you're in. Some investors might be okay with lower cap rates in high-demand areas because they're looking for appreciation rather than cash flow.
Got it. So it's about balancing cash flow and potential appreciation based on your investment goals.
Exactly. And when evaluating deals, having a checklist can really streamline the process. You want to include things like location, condition of the property, potential for appreciation, and the current rental market conditions.
So with location, what are the key factors to consider?
Well, look for areas with good schools, amenities, and employment opportunities. You want to be in a place that attracts renters. And keep an eye on trends, like new developments or infrastructure projects. Those can boost property values.
And what about the condition of the property? How can you assess that?
A thorough inspection is crucial. You want to identify any major repairs that could eat into your profits. Things like roofing, plumbing, or electrical issues can be costly. It's worth investing in a good inspector.
Makes sense. And when it comes to financing, what options should investors consider?
There are a few different paths. Traditional mortgages are common, of course, but you might also explore portfolio loans, which allow you to finance multiple properties under one loan.
I see. And what about down payments? How does that work with multiple properties?
Generally, you'll need a larger down payment for investment properties, usually 20% or more. But there are some programs out there that let you put down less, especially if you're planning to live in one of the units.
That's good to know. And what about those who have already bought a couple of properties?
Refinancing can be a way to free up cash for your next purchase. If your property has appreciated, you can tap into that equity. Just remember to consider the costs involved in refinancing.
Right. So it's all about understanding your numbers and making sure the investment makes sense.
Absolutely. Another rule of thumb is to ensure you're not over-leveraging. Aiming for a debt-to-income ratio below 36% is a good guideline to follow, which means your mortgage payments should ideally be less than a third of your income.
That's a solid rule. But what if someone finds themselves above that ratio?
Well, it can be tricky. They might need to look into increasing their income, reducing expenses, or even selling a property to get back on track. Staying within that ratio is key to maintaining financial health.
And how does this tie into getting approved for multiple properties?
Lenders typically want to see a solid financial picture. If your debt-to-income ratio is too high, they may hesitate to approve additional loans.
Okay, so monitoring your finances is crucial. What about the type of properties? Are there certain types that are better for multiple investments?
Single-family homes are often easier to manage and finance, but multifamily properties can provide better cash flow. Each unit can generate income, which might help you qualify for more properties in the long run.
That makes sense. So having multiple streams of income from one property can really help.
Exactly. And don't forget about commercial properties. They can be a bit more complex, but they often come with higher potential returns.
Right, but I bet they also come with their own challenges and risks.
Oh, for sure. It's important to do your due diligence. Understand the market and the specific risks associated with commercial real estate before diving in.
So it sounds like doing your homework and evaluating your options is key, huh?
Totally. And even with all these strategies, you should be prepared for some common pitfalls.
Oh? Like what?
So one of the biggest pitfalls I've seen, Sarah, is over-leveraging. You know, people get so excited about their first few properties that they just keep borrowing more and more without really considering the risks involved.
Yeah, that makes a lot of sense. I mean, it's easy to get caught up in the excitement, right? But how does that usually play out for investors?
Well, I once worked with a guy who had, let's say, a knack for finding deals that seemed too good to be true. He bought multiple properties in quick succession, all with high loans. Initially, it looked great on paper, but then the market shifted a bit, and suddenly he was cash flow negative on several of them.
Oof, that sounds stressful. So what happened next?
He ended up having to sell a couple of properties at a loss just to stay afloat. It's a classic case of thinking that the rising market would always cover the risks, but it doesn't always work that way.
Right, and I guess that's where understanding your cash flow comes in, huh?
Absolutely. Ignoring cash flow is another common mistake. Investors often focus on potential appreciation rather than the day-to-day income from the properties. There was another client of mine who bought a property in a trendy area, and while the value was increasing, the rent he was getting didn't even cover the mortgage and expenses.
Wow, that must have been a wake-up call.
It really was. He thought he'd make money when he sold it, but, he really struggled to keep up with payments in the meantime. It's crucial to have a solid cash flow strategy and not just bank on future profits.
Definitely. So what should investors do to avoid these situations?
First off, always run the numbers. Look at the rental income versus your expenses. And don't forget things like property management fees, maintenance costs, and unexpected repairs.
Hidden costs can really sneak up on you, can't they?
Oh, for sure. I had another investor who was so focused on the property price that he didn't account for the age of the roof or the plumbing system. He ended up spending a fortune on repairs shortly after purchase, and it ate into his cash flow significantly.
That's such a good point. It's like, you think you're getting a good deal, but then those hidden costs just keep popping up.
Exactly, and it's not just about the property itself. You also have to consider the area. I remember a couple who bought a rental in a neighborhood that was kind of up and coming. They thought they'd be riding the wave of gentrification, but they didn't realize that crime rates were also on the rise.
Yikes. What happened there?
They had trouble finding reliable tenants, and when they did, they ended up with some really bad ones who, didn't pay rent on time or at all.
That's such a tough lesson to learn. So how do you spot those red flags early on?
Well, do your research. Look into local crime statistics, talk to neighbors, and visit at different times of the day. Also, check on rental demand in that area. If you see a lot of vacancies, that's a big red flag.
Yeah, it's important to know what you're getting into.
Exactly. And timing the market can also be a trap. I've seen investors try to time their purchases with market highs and lows, thinking they can snag the best deal.
That's risky, isn't it?
Very. Market conditions can change quickly. I had a client who waited for what he thought would be the perfect moment to buy, but the market just kept rising. By the time he finally decided to pull the trigger, he ended up paying way more than he initially planned.
So, what's the alternative? Just buy when you find a good property?
Yes, focus on the fundamentals. Look for cash flow positive properties, regardless of the market timing. It's better to buy a solid property that meets your criteria than to wait for the perfect moment that may never come.
That makes a lot of sense. Are there any other pitfalls we should be aware of?
One more I'd mention is not having a solid exit strategy. You have to know when to cut your losses. If a property isn't performing as expected, hanging on too long can be detrimental.
Right, so you need to have a plan in place for both success and failure.
Exactly. And if things aren't going well, don't be afraid to reach out for help or advice. It's okay to pivot when necessary.
So basically, the key is to stay informed, be realistic about cash flow, and keep an eye out for those hidden costs.
Yep, and don't let the excitement of new properties blind you to the financial realities. It's all about building a solid portfolio over time, not just chasing quick wins.
That's such valuable advice. So if someone finds themselves in a tough spot, what are the first steps they should take to recover?
First, reassess your situation. Look at your cash flow and expenses closely. Identify where you can cut back and start prioritizing your properties. If necessary, consider selling off a property that's dragging you down.
That's really practical. It's all about making informed decisions, right?
Exactly. And don't hesitate to consult with professionals, whether that's a financial advisor or a real estate mentor. They can provide perspective and help you find a path forward.
It sounds like there's always a way to recover, as long as you're willing to adjust and learn from the experience.
Absolutely. Real estate investing is a journey, and like any journey, there will be bumps along the way. But with the right mindset and strategy, you can navigate through them and come out stronger.
Well, that's a great note to end on. Thanks for sharing these insights, Mike.
My pleasure, Sarah.
So folks, keep these lessons in mind as you move forward in your real estate journey.
So now that we've talked about how to get approved for multiple properties, let's dive into some practical next steps you can take right now.
Yeah, I think that's super important. It can feel overwhelming, but starting small is key, right?
Exactly. One of the first things I recommend is to analyze deals regularly. You could start by setting a goal to analyze just one deal a week. It doesn't have to be a big commitment. Just pick a property, run the numbers, and see if it makes sense as an investment.
That sounds doable. And what tools can people use to help with that?
Well, there are some fantastic apps out there. For example, the Bigger Pockets Calculator is a great tool for analyzing cash flow, ROI, and other important metrics. It's user-friendly and can help you get a feel for what works and what doesn't.
I've heard of that one. What about others?
Another good option is DealCheck. It's similar, but offers a bit more in terms of analyzing various property types, and even allows you to compare multiple properties side by side. It can save you a lot of time.
Nice! And what about rental properties?
For rental properties, Rentometer is a fantastic tool. It helps you analyze rental rates in a specific area, so you can see if your potential rent is competitive or if you need to adjust your expectations.
That's really helpful. And I assume local MLS access could be a game changer too?
Absolutely. If you can get access to your local multiple listing service, you'll have a wealth of data at your fingertips. Listings, sales history, neighborhood trends. It's invaluable for finding the right investment opportunities.
So in addition to those tools, are there any books or podcasts you'd recommend for people looking to deepen their knowledge?
Oh, definitely. For books, I always suggest Rich Dad, Poor Dad by Robert Kiyosaki. It's a classic. And the book on rental property investing by Brandon Turner is also a must-read. It covers a lot of ground for beginners and seasoned investors alike.
I love those recommendations. And what about podcasts?
Well, the Bigger Pockets podcast is a great listen. They share real-life stories from investors of all levels and tackle various topics in real estate. It's a fantastic way to learn while you're on the go.
That's perfect for those long commutes. And speaking of learning, I think joining a local meetup can be incredibly beneficial too.
Yes, networking is key. Local meetups allow you to connect with other investors, share experiences, and even find potential partners. You'll be surprised at how much you can learn just from conversations with others in your community.
It sounds like a great way to build confidence too. Getting involved in the community can really help you feel more supported.
For sure. And don't forget to start small. If you can, try to set aside a bit of time each week to focus on your investing education. Whether it's reading, listening to podcasts, or analyzing deals, just carve out that time.
Right. And even if it's just 30 minutes a week, it adds up. Keeping consistent habits is essential.
Definitely. You could also track your progress with a simple checklist. Write down your goals, the tools you want to use, and the properties you've analyzed. It'll help you stay focused and motivated.
I love that idea. And it's so satisfying to tick things off a list.
Exactly. And don't be afraid to adjust your goals as you go. If one deal a week feels like too much, start with one every 2 weeks, or even one a month. Just make sure you're moving forward at a pace that works for you.
Yeah, the key is to keep pushing yourself, but not to the point of burnout.
Right. And remember, the goal is to build that long-term wealth. It's a marathon, not a sprint.
So true. And speaking of building wealth, what about considering other investment strategies?
Great point. Diversifying your portfolio can also be beneficial. Look into options like real estate investment trusts, REITs, or even starting with house hacking, living in one unit and renting out the others. It can help you get into the market with less financial strain.
That's a smart way to start. And it's practical for those who may be hesitant to jump right into multiple properties.
Exactly. The more you learn and experiment, the more comfortable you'll become. Just, take it step by step.
With all of these tools and strategies at your fingertips, it really feels like anyone can start their real estate journey, no matter where they're starting from.
Absolutely. And with that mindset, you're already on the right path.
So those are some practical first steps. Now let's bring this all together.
Well, Sarah, as we wrap up this episode, I think it's important to highlight some key takeaways from our discussion on getting approved for 5 or more properties.
Absolutely, Mike. One of the first points was the importance of your credit score, right? A strong score can really make a difference in securing those loans.
Yeah. And then there's the idea of showcasing your cash flow. Lenders want to see that you can manage the expenses and still have a positive income from your investments.
Right, and we also talked about the significance of having a solid financial plan. It's not just about the properties themselves, but how they fit into your overall strategy for wealth building.
Exactly. And don't forget the importance of networking. Building relationships with lenders, real estate agents, and other investors can open up new opportunities.
Oh, for sure. Those connections can really help you navigate the complexities of multiple property ownership.
And finally, patience is key. This isn't a sprint, it's a marathon. Building wealth through real estate takes time and perseverance.
That's such a great point, Mike. For anyone over 40, it's never too late to start investing and building that long-term wealth. You just have to take that first step and keep moving forward.
And remember, if you found this episode helpful, subscribe, and leave us a comment with your biggest takeaway or a question you might have. We love hearing from you.
Yeah, and don't forget to share this with anyone you know who's over 40 and interested in property investment. It could really help them out.
Next time, we'll dive into a crucial topic, real estate in a recession, our outlook for 2026.
It's going to be a great discussion, so you won't want to miss it.
Thanks for tuning in today.
We appreciate you spending this time with us.
Until next time, take care and happy investing.
Bye for now.